Welcome to another episode of Map Your Money. I'm one of your hosts, Arish, Nurani, wealth advisor and certified financial planner here at BGA Wealth. I am joined by Jeff Cohn, our chief investment officer and CFA charter holder here at Beam and BGA Wealth. Great to have you, Jeff. How's it going?
Hey, man, no complaints. It's warming up in Columbus, Ohio. Getting a little sweaty, but that means my trip to Oklahoma and Eufaula Lake is coming up, so I'm very excited.
Oh, yeah.
My golden doodle got trimmed today as well, so now he can finally enjoy the warmer weather. Everything is going great, dude. How you doing?
I'm doing well. Excited for this episode. Have some really interesting topics lined up. Going to be recapping what we've seen in the market and the economy this year. Almost halfway through the year, but before we jump into all of that fun stuff, want to start with an icebreaker like we usually do, and I just got to talk about this news story because it just makes me laugh so much. Jeff, have you seen the movie Her? It's with Joaquin Phoenix and Scarlett Johansson,
I remember
who plays
the previews, but I never saw it.
Yeah. So basically, the whole
Does
premise
he like fall
of the
in
movie,
love with like an AI?
He falls in love with an AI. I think it's like a 2011 movie. So it's like way before that was like really a thing. Siri was just kind of getting introduced. But this is like a super advanced AI. And the voice who played the AI was Scarlett Johansson's voice. So fast forward to today, or last week, OpenAI, who makes ChatGPT, they released their new model of ChatGPT, their 4.0. And the big feature was that you could talk to the AI and talk to the ChatGPT. So they have a couple different voice options, but the main voice sounds exactly like Scarlett Johansson. And so it came out that 9 months ago.
I've definitely heard about this. It's been talked about.
Yeah. It came out 9 months ago that Sam Altman, who's the CEO of OpenAI, the creators of ChatGPT, asked Scarlett Johansson for permission to use her voice, and she said no. But they went ahead and basically used it anyway. Apparently, they got a voice actor who sounded exactly the same. Obviously, Scarlett Johansson's not happy with this, so she sued them. I have the ChatGPT, and they took that voice away. But I just think, and then the icing on the cake was that after it released, Sam Altman tweeted just her. And I was like, he's just bragging at this point. I just think it's a hilarious
Is it really
story,
imitating or mimicking if they're using a voice actor? I think that's
their
really
legal
replicating
argument.
or stealing her likeness, right? That would be the issue.
Yeah, but they kind of are. I don't know. That's definitely too much in the legal weeds for me, but I just think it's hilarious.
Right? So I was gonna say, this is interesting with AI, and how they can imitate voices, and obviously we've seen how they can do this with videos too. But I'm still on my mom's phone plan, and I Venmo her for that every month. And I recently upgraded to the new iPhone, and when I did, I had to call my mom, and she had to confirm it, with the account people. And so I just called her. I'm like, hey mom, it's Jeff. Approve this for the Verizon guy. Here you go. And she just approved it, no questions asked. And I was like, hey, by the way, in the future, we need to have a security question because it's going to be easy to imitate my voice. And I'm sorry, mom, I know you love me, but you won't know the difference, And I think maybe that's a good example of, even though AI is going to be extremely innovative and it's going to be beneficial in a lot of parts of the economy, it can also be used in morally negative ways, right? And I think there needs to be some sort of ethics around that. And what's interesting is ChatGPT apparently was very tuned into that. But now maybe they're going another way.
Interesting. Yeah, no, the fraud around AI is continuingly to be a very scary aspect of this progression of technology. But I think it's something that we need to be aware of and looking at. And another main point is hopefully you don't fall in love with your AI, like apparently ChatGPT wants you to. So
they have AI and they have dolls that are getting more and more realistic. I don't know if I like where this is going.
Yeah.
This is getting weird.
I've seen too many of these movies that go south. But without further ado, we'll jump into the better stuff about the market and economy. But let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right, so we are almost halfway through the year. It feels like this year has flown by. We're recording here on May 23rd, and gonna get this out before the end of May. But I guess, Jeff, just recap us on what we've seen in the markets and economy so far this year, where we're at.
Sure. Hey, before we do that, I don't know if you saw, last night there was this survey released asking people what they thought of the current economy, right? And this has been an issue for a while, where we're seeing consumer confidence surveys that show a consumer that's not confident, that's saying the economy is not treating them well, but at the same time, that same consumer is going out and buying durable goods, recreational goods and services, discretionary items, right? Indicating that they actually do have confidence, right? So listen to the stats of the survey, dude. This is mind-blowing to me. 55% of people polled believe the economy is shrinking, and 56% think the U.S. is experiencing a recession. 49% believe the S&P 500 is down this year. And 49%. So, I mean, I don't know what those people own. 49% also believe that the unemployment rate is at a 50-year high.
Oh my gosh.
A 50-year high. Okay, well, what is going on? Do people not own Google? I'm just like so confused because, you know, we're going to talk about the unemployment rate and the stock market. I know you asked about that. We'll get to it, but it's at a 50-year low, basically, you know, and like if you ignore like the previous few months where it was like a few ticks lower, right? And the stock market is not down. You know, it's like these kind of things I think are very shocking to me, and I think it's consistent with a lot of the things that we've been seeing from the consumer, saying that wow, like they're really not feeling some of the economic strength that we're showing. But anyway, I don't know if you saw that, but I wanted to bring that up. Very strange. What are your thoughts?
No, I hadn't seen that. That's super interesting, and I always kind of question who is being surveyed in these surveys. But I definitely think the moral of that is always going to ring true. I think the place where most people are getting information in terms of what's happening with their money, what's happening with the economy, is always going to be kind of negative leaning, because all of it's coming from these different news sources, different outlets that at the end of the day, they're a business and they have to kind of get eyeballs on the screen and stay on the screen so they can sell ad revenue. And the way they do that the best is by selling fear. And so I'd honestly be really curious to see like what that survey has looked like in different time periods, how healthy they think the economy is. I bet it's never like there's never a period where they're like, oh, the economy's doing great.
From reality.
Yeah. There's never really a point, I think, if you're just looking back through time and say you're always surveying people and say, okay, how do you think the economy is? How do you think unemployment is? I don't really think there'd be a point that I can point to, especially if they don't think right now is that they're like, things are healthy. The economy is good. But I think that's one of the morals we're about to talk about right now, is that the economy has been extremely, extremely healthy.
All right, yeah. So, I thought that was interesting, Arish. We'll see if consumers, maybe learn how to Google, or maybe some media companies will give some accurate information, or we'll see what happens. But anyway, hey, you asked me how the markets are doing this year. So let me give you a quick recap. So, these numbers are as of the close on May 17th. But when you look at the S&P 500, not down this year, it's actually up 11.8%. The NASDAQ up 11.5%. Small cap stocks up only 4%, and the Dow Jones up a little under 7%. So, still a good continuation of strong returns. The S&P 500 is now up almost 30% in the last year, and has averaged 10% a year over the last 3 years. So overall, this is, pretty good returns here. Bonds, are down a little bit to start the year because rates are a little higher as the market has had to kind of decrease their expectations for the number of Fed cuts. But we've also had some other things doing pretty well in the markets. Metals are doing extremely well. Metals like steel and copper and gold are hitting new highs. Utilities have also done really well on kind of the pickup in the trade of the increased power consumption and demand that some data centers and some AI models are going to be using. And of course, short duration bonds and high yield continue also to do well in an environment that has been pretty strong, has been resilient, and an environment where rates have gone up a little bit, which is when short duration outperforms. Overall, I think if you think about the economy and some economic data that we're getting, inflation has come in a little hotter than expected, to start the year. We've seen some Fed officials come out and say, we have not seen further progress in hitting our inflation target, right? So kind of admitting that there's been some progress. We went from 9 to 3, but haven't really seen much since then. But a lot of that rhetoric has been about the Fed more delaying rate cuts rather than canceling rate cuts or really triggering rate hikes, right? So overall, the economy keeps chugging along, and I think we had that little bit, 5% pullback in April on those inflation scares and rates going up a bit. But, we went into May and we got all of those losses back plus some. And, NVIDIA just reported earnings and they were really good. So, hey, we're still hitting new all-time highs.
Yeah, definitely. I want to kind of circle back to that point about inflation. And I know you mentioned it's been a little bit hotter than expected, but I want to kind of caveat that or add some more context there. Inflation's actually been fairly low compared to what we've seen or what we saw, especially in 2021 going into 2022 when we were really hitting those really high inflation numbers. And so inflation has been in this 3% range for the last year now. So for the last year of prints, it's been in this 3 to 4% range, not going over 4%, not going under 3%. And the Fed's target there with inflation is 2%. So we're still a little ways away from that. And they definitely want us to get us there at some point. But kind of coming into this year, even part of last year, it was really expected that with the Federal Reserve coming in and hiking these interest rates up to moderate inflation, that something in the economy was going to break. We were going to see unemployment spike. Something was going to go wrong. And then this would have to kind of force the Fed's hand. They would then have to bring interest rates down. And if you've noticed kind of across the board, interest rates have stayed high. And you mentioned kind of how they've edged up here recently. But one of the reasons is because the economy has been so strong. We talked about that survey there at the top and mentioned how actually strong the economy truly is. And it's probably not something that the everyday person or investor might realize, but the economy has been doing really well. And it's been the reason for interest rates staying high at this point.
Yeah, I couldn't agree more. I mean, if you think about like what the economy is, right? Like how do we measure the economy? We measure it based on spending or we measure it based on income. And those are really just two sides of the same coin, right? Spending that I do is income for someone else. And if we look at consumer real income, so adjusted for inflation per capita, that's trending higher. So that means, consumers are actually earning more beyond inflation. And that trend has continued from prior to COVID, right? So we're actually seeing this very consistent trend upward. Income supports spending, and we know what consumers like to do when they receive income. They like to spend it, right? The stock market's going higher. Consumers have confidence about their incomes, which means they're saving less and less of their money, which we're also seeing. The savings rate is positive, but it has declined. Consumers are spending more. And we look at where consumers are spending money. Like I said at the top, it's kind of on these discretionary categories: hotels, restaurants, recreational goods and services, and like these are not areas that consumers typically increase their spending when the economy's poor. And then, lastly, if you look at business spending and some of the components there, we've seen a bit of a slowdown in growth of spending on stuff like machinery and equipment, but on items like, structures like new factories or intangible property rights and intangible assets, their spending is actually still growing, right? And it's growing at quite a healthy clip. So, everything that we see from the economy it's surely not gangbusters like it was in 2021, right? But I think it's certainly pretty strong compared to what you would think, considering where monetary policy is, and still right at or above trend growth, which I think is pretty remarkable.
Yeah, definitely. And I know we kind of alluded to it earlier, but I think now is a great time to kind of talk about unemployment with the overall economy.
Yeah, so unemployment is not at a 50-year high. I hope that's very clear. So the unemployment rate right now is at 3.9%. But I think it's really important for us. Let's peel back this onion a little bit and talk about what goes into this measure, because it's criticized quite a bit, right? So to be counted as employed in this survey, they go around and they call over 60,000 households, and they have this survey and they ask a question: have you worked for pay for at least an hour during the last week? If they say yes, for at least an hour for pay, then you're employed. You are counted as you have a job in that survey. If you say no, I've not worked for at least an hour for pay, they ask you a second question: were you looking for work in the previous 4 weeks? If you say no, then you're not counted as unemployed. You're only counted as unemployed in this measure if you don't have a job and you are actively seeking employment, right? As in applying for jobs. And so a lot of people will say, well, there's some people that are trying to get jobs, but they stopped looking for jobs. And now since they stopped looking, they're not counted as unemployed, but really they still are, right? And those people, it's true, they're not included in that unemployment rate. So what we use is a rate that includes some of those other factors, right? That looks at, okay, what about the people that they call them marginally displaced, discouraged workers that don't have a job, looked for a job at some point in the past year, but stopped looking in the past 4 weeks because they just straight up think there are no jobs for me, right? So we include those in there, right? Because maybe those should be counted. There's also some people that are counted as employed because they worked for at least 1 hour, but they're working part-time and wish they worked full-time. Well, that's pretty important too if we're assessing the health of the economy, right? Is the economy healthy enough to sustain employment on a full-time basis for a lot of people, or are there more and more people that are working part-time for involuntary reasons? They'd rather work full-time. And so when you add in some of those measures to the traditional unemployment rate, you get something called the U6 unemployment rate. And this right now is not at 3.9% like the U3 unemployment rate, the headline unemployment rate. It's actually at 7.4%. However, this is also not a 50-year high, and this is actually at some of the lowest rates that it's been for a while. And usually when this rate is below 8%, that's kind of commensurate with the headline unemployment rate being below 4%, and that's kind of a level that is about as low as it gets. That kind of signifies full employment. And to your point, when we look at these measures, not only are they extremely low, and they're low on an absolute basis, they're low on a relative basis to prior periods, but they've been low for a really, really long time. I actually checked before this and looked at the longest duration that the U6 unemployment rate has been below 8%, and it's 34 months back in the early 2000s, late 90s or early 2000s, 34 months. Right now we're at 30 that we've gone below 8%, and for a while there we were below 7%. So employment actually remains really, really healthy. It remains healthy even when you include all those other people that are typically excluded from the headline rate. And I think, even though it's rare for unemployment to stay so low for so long, maybe this time is different.
Yeah, and I think you brought a lot of really good points there. I think people they look at the unemployment rate and say, hey, this isn't counting me or my friend or this situation because, well, however they count it, and just kind of explained how it's measured there. It doesn't include this person or that person. But I think the kind of big thing to recognize there is we're looking at this at a full country's level. And so the whole entire country, and trying to measure the success of the economy and the health of the economy based off of this measure. And so no statistic really is going to be perfect in how it's measuring its data. I think the most important thing, kind of looking across most metrics in finance, is looking at the trend and saying, okay, how is this compared to in the past? A number just in obscurity, just when you threw out that U6 number, 7.4%, I have no idea if that's high, if that's low, if that's healthy, if that's good. But when you kind of look at the trend, okay, this has been at the lowest level we've seen for the last 30 months. Kind of, I'm guessing 30 months dates back to probably like March 2020, somewhere around then.
30 months below 8. So that's not even measured.
30 months below 8. Okay. Yeah. Well, I'm still guessing that still would get us right back to like COVID though, when it was above.
It's basically like right there at COVID when we reopened in 2021 at some point. Yeah, but like, it's typically what we see is unemployment falls, and it falls for a while, and then it reaches that low level, and then it spikes again because that's right when we have another recession. And what we've seen this time, and even though we've expected that internally, that broad-based weakness really hasn't materialized, and unemployment has stayed really low. So. I think that's good for a lot of different reasons. And to your point, it's not that we're trying to find a perfect measure, but we are trying to understand what these measures tell us, understand what they don't tell us, and then take that for what it's worth, right? And to your point, we're looking at the trend and we're looking at the level. And both of those, I think, for unemployment and frankly for inflation, are pretty good.
Yeah, and I think like the ultimate question that everyone always has is, okay, what's next? What are we going to see going forward? And I think it's really dependent on how healthy these levels stay and what happens to inflation, because that's ultimately what the Federal Reserve is looking at, the health of our economy and how high inflation is.
Price stability and full employment, as they would say.
Exactly. They're two parameters of what they're major or really looking at. And so if inflation starts to spike back up out of this 3% range up to 4 or 5, that might lead to interest rates going back up. This isn't really expected. No economists are really predicting this kind of across the board, but that is technically a possibility. What I think is more widely consensus in terms of the view is that we'll either stay in this range or start to hopefully trend downward, and either something in the economy breaks, or more likely now is kind of seeming that, okay, the Federal Reserve is just going to have more room to bring this interest rate down as kind of this rate gets more inundated into the market, and it becomes kind of more used to it and able to have that ability to bring rates down without necessarily spiking inflation back up. Am I kind of right?
Yeah, no, I think you're right. Like, so it's interesting. I've asked some people, they've said, like, if the Fed cuts rates too early, it's going to spur a lot of additional inflation. But I always ask them, I say, well, haven't we been talking about how the economy is not as sensitive to interest rate changes as we thought it was? I mean, the Fed hiked interest rates from 0 to 5.5%, and we're still talking about how houses are still being built, businesses are still spending money, consumers still have jobs and are spending money. So why are we expecting a cut in rates to really cause this surge in inflation? Like, I think that's kind of counterintuitive based on, the premise of the economy is more resilient to higher rates. I don't know. And I also think like there's this thing about, think about inflation. Most of inflation that we're experiencing right now, especially in the CPI index, is from shelter, is from shelter prices and housing prices. Well, how do you fix high housing prices because of supply shortages? Well, you build more houses. Well, what makes it tougher and more expensive to build more houses? Higher interest rates. So if the Fed lowered interest rates, would it incentivize additional building of houses and maybe fix some of the problem that's causing some of this inflation? I think there's something to be said there. I really think so.
Yeah, no, that's really interesting when you kind of put it like that. But I know we've kind of gone through a lot. We talked about the updates and sort of what we've seen in the market. Started off with thinking about like the S&P was a really hot start to the year. We had this pullback in April as inflation came out a little bit hotter than expectations. Saw like a 5% pullback in the S&P 500, and now we're back to all-time highs, and has really been a year of a lot of all-time highs, and it's been a year of a really strong economy. So hopefully we continue to see that the markets continue to churn, and we keep trending in that direction.
Yeah, I agree. I think we've hit over 20 new all-time highs. So the S&P is up this year, and I think what's interesting is when we hit new all-time highs, it's usually because whatever we were worried about that caused the drawdown has passed, right? And now we realize that it's either corrected itself or we were a little too exaggerated on the downside, right? Overreacted. And so what typically happens is, the natural direction for stocks, these are businesses that earn money, that accrue income for their shareholders. The natural direction is up, and as long as there's something that's not holding that back and we're in a normal economic period, that's where you expect stocks to go. And that's why new all-time highs typically continue on to lead to additional new all-time highs. And, something I would point out before we sign off is we had this 5% pullback in April. And pullbacks always suck because you know they're coming. The average pullback for the S&P 500 any given year is 14%, even though the S&P finishes higher 75% of the time in those calendar years, right? So we know pullbacks happen. They happen every year, even in good years for the stock market. But they always happen for some reason that seems like a legitimate reason to sell stocks. That's why stocks ultimately get sold and they sell off. And I think what's interesting about this recent pullback is it was as scary as all the others, with so many people going for the exits and clamoring for the exits really quickly, but it only ended up being a 5% pullback. And we have so many clients that talk to us about, 15% pullback and how tough that was, and a 20%, 25% pullback, and how tough those can be. And they say, we just kind of find a way to avoid this. And I think what's really tough about that is, how do you know the 5% pullback is going to turn into that? I think over the history of the S&P, we've had, over 65% pullbacks that didn't end up being anything more than that, right? And it was just a 5% pullback. So I think that's kind of a good lesson, right? The people that suck it out, sometimes that's what happens, And then for other people that get scared and sell out, well, you just sold out when it only went down 5%, and now it's right back at all-time highs. What do we prefer to do? Just don't play that game. There's going to be a pullback. Be able to stomach that volatility. And if stocks really do get cheap and they have to rebound, then buy more. Rebalance. And that's what we do.
Exactly. And I love this graph. We'll pull it up here if you're watching on the YouTube. If you're just listening, we can kind of describe it here. But it's basically what Jeff just outlined. But it's showing all the pullbacks in the market, in the S&P 500, or the calendar year returns dating back to the 80s, and showing that an average intra-year drop of 14%, yet annual returns are positive in 33 to 44 years. And so the red dot on each of these is kind of the biggest pullback that we had in that year. And so this year it's 5%. But last year, calendar year 2023, was a 10% down, yet at the end of the year we ended up 24%. And so we definitely agree that being able to ride the storm per se is advantageous throughout, and not trying to time the market is definitely a huge proponent to success with investing. But I think we covered a lot, and appreciate your time on the podcast, Jeff. Hopefully I'm not falling in love with an OpenAI platform by the next time we meet, and we're good to go.
Man, you better be careful out there, Arish.
No, they took off the Scarlett Johansson voice, so I think I'm good.
There are a lot of capable, available women out there, Arish. Okay, just hold on to hope.
Alrighty. All right. Signing off.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third parties' views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Benedetti Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.